Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. Now let's begin in North America. The Organization for Economic Cooperation and Development has warned that Washington's recent trade and tariff policies are pushing the global economy toward slower growth and higher inflation. In its latest report published yesterday, the Paris-based organization revised down its global growth forecast, predicting a slowdown to 3.1% this year and 3% in 2026. The OECD attributed the deceleration to rising trade barriers, heightened uncertainty, and declining business investment and consumer spending. Among the economies hit hardest by the trade tensions, Canada's growth is expected to drop to less than half of the OECD's previous forecast, while Mexico is projected to enter a recession. The US itself is set to see a significant slowdown, with growth expected to fall to 1.6% next year, the weakest since 2011, excluding the COVID-19 pandemic. Rising trade costs will also drive inflation higher than previously expected, forcing central banks to maintain restrictive monetary policies for an extended period. In the United States, core inflation is expected to remain above policymakers' targets through 2026. Now, of course, these are all just projections, and this could certainly change. We do live in very interesting and uncertain times, of course, where a lot can happen in a few months. We also point out that this is all assuming that tariffs remain in place. Some commentators argue that the United States President Donald Trump is using tariffs as a negotiating tool, that is, a form of leverage. Therefore, it is unclear whether this trade stance will remain in the medium to long term. Indeed, some commentators believe that it is only really with China in which a long-term trade or tariff war is in the cards. Nevertheless, the OECD's assessment represents one of the most comprehensive attempts to quantify the economic damage from the escalating trade wars. While the Trump administration was anticipated to implement protectionist policies, the speed and severity of tariff impositions have caught policymakers and investors off guard. Last week, US stocks entered a correction phase, with the S&P 500 plunging 10% from its February peak. President Trump, however, has downplayed the market turmoil, stating that the country is going through a, quote, period of transition, end quote, as he seeks to overhaul global trade and bring manufacturing back to America. Trump has been on record as saying that the current trade status quo around the world has been built on American strength and has disproportionately benefited the rest of the world while failing to benefit the United States. The OECD's analysis factors in existing US-China tariffs and broad-based 25% levies on steel and aluminium imports. It also assumes additional 25 percentage point tariff increase on Canadian and Mexican goods with equivalent retaliation. According to an OECD simulation, a scenario in which bilateral tariffs are permanently raised by 10 percentage points could shrink global output by 0.3% within 3 years. The US economy would suffer disproportionately, facing a 0.7% decline in output. Inflation would also surge, prompting tighter monetary policies and disruptive financial market repricing. The OECD Secretary General emphasized the risks of escalating trade tensions, telling US-based Bloomberg Television this week, quote, "We are pointing to significant downside risks, including further trade fragmentation," end quote. However, the OECD noted that if tariffs were lowered and trade policy stabilized, economic growth could be stronger than currently projected. Next up, we now move to Asia. Japanese companies are undergoing a corporate governance transformation, moving beyond simple share buybacks to placate investors. Major conglomerates are now restructuring, replacing executives, and selling non-core assets as they respond to shareholder demands for deeper changes. Toyota, Japan's most valuable company, recently announced a significant board reform, reducing its size from 16 to 10 members and increasing independent directors to half. This move, along with the creation of a supervisory committee, aims to strengthen management oversight ahead of its annual meeting in June. UK-based The Financial Times writes that the shift marks a departure from the long-standing reliance on record-breaking share buybacks. Investors, emboldened by Japan's growing corporate governance reforms, are demanding more substantive action, such as higher dividends and board shake-ups. Japan's corporate governance reforms, driven by regulatory changes, have seen a dramatic increase in independent directors on company boards, from less than 10% in 2014 to over 98% today. This has encouraged activist shareholders to push for leadership changes at major firms like Kao and Sapporo. As David Mitchinson of Zenor Asset Management put it, Writing large shareholder checks is easy, but meaningful reforms requires alignment of corporate strategy and divestment of underperforming assets. Meanwhile, while we're still in Japan, Warren Buffett's Berkshire Hathaway has increased its holdings in 5 major Japanese trading houses to nearly 10%, reinforcing Buffett's earlier commitment to gradually bolstering investments in these firms. The varying ownership percentages reflect differences in outstanding shares, as some firms have cancelled buybacks, while others retained them as treasury stock. Shingo Ide, chief equity strategist at NLI Research Institute, noted mixed reactions to the news. Quote, "It's positive that Berkshire followed through on its commitment, but some may see caution in its decision to keep stakes under 10%. End quote. Berkshire, through its subsidiary National Indemnity Company, disclosed the increases after Tokyo markets closed yesterday. Japan's regulations require investors with over 5% ownership to report changes of 1% or more. Buffett's 2023 visit to Japan and continued investments have significantly boosted confidence in Japanese equities. Since Berkshire's recent disclosure, shares of the 5 trading houses have risen, with Itochu up 13.1% and Mitsubishi 11.2%, and others posting strong gains. As Berkshire stated in its latest shareholder letter, quote, "As the years have passed, our admiration for these companies has consistently grown." End quote. Next up, we move to the European markets, but just quickly, if you're getting some value from today's episode of Market Update, don't forget to hit the like button, and if you want to be on top of all future updates as they're released, maybe consider subscribing. Next up, and finally for today, the United Kingdom's long-standing reputation as a haven for the ultra-wealthy seems to be crumbling. With the abolition of the non-domiciled individuals non-dom tax status set for April 2025, a significant shift is underway as Britain's richest residents consider relocating to more tax-friendly jurisdictions. The consequences of this policy shift are already being felt, as financial advisors report an uptick in inquiries from high-net-worth individuals looking for an exit strategy. For over 2 centuries, the UK's non-dom regime allowed wealthy residents to shield their global earnings from taxation, paying a fixed fee instead of full income tax on overseas assets. This system, which dates back to 1799, making it almost as old as the United States, enabled foreign nationals living in Britain to avoid taxes on international income for up to 15 years. However, Prime Minister Keir Starmer's Labour government is now dismantling this arrangement, replacing it with a 4-year tax exemption for new UK residents before they are subjected to full taxation on global income. The implications are immense. The British Treasury estimates that the reform will generate an additional £2.7 billion annually, yet critics warn of potential economic fallout. The Adam Smith Institute predicts that the policy could reduce investment and spending, leading to the loss of 23,000 jobs over the next 6 years. As tax pressures mount, the elite are looking elsewhere. According to Henley and Partners, a global investment migration consultancy, 10,800 millionaires left the UK in 2024, a 157% increase from the previous year. The firm predicts that 135,000 high net worth individuals will relocate in 2025 alone. The report noted, quote, "As the world grapples with a perfect storm of geopolitical tensions, economic uncertainty, and social upheaval, millionaires are voting with their feet in record numbers." End quote. The United Arab Emirates, UAE, has emerged as a top destination, attracting 6,700 high net worth individuals in 2024. The United States and Singapore follow closely behind, each drawing thousands of wealthy migrants. With zero personal income tax and business-friendly policies, the Middle East, particularly the UAE and Saudi Arabia, is positioning itself as a new hub for the ultra-rich. Not all millionaires are moving to the Middle East, though. Many are opting for European alternatives, such as Italy, Greece, Portugal, and Switzerland, which offer attractive tax regimes. Italy, for instance, has a flat tax of €200,000 on global income, which has enticed many former UK non-doms seeking financial certainty. Beyond physical relocation, many wealthy individuals are rethinking their global asset allocation. Experts note a rising trend of selling off UK properties and reinvesting in lower tax jurisdictions. Family offices are increasingly diversifying their portfolios, moving capital toward North America and Asia-Pacific markets, particularly the United States technology sector. The UK's tax overhaul is part of a broader trend of global governments governments cracking down on tax avoidance. The OECD's Common Reporting Standard, CRS, now requires financial institutions to report foreign tax residence accounts, limiting the effectiveness of offshore tax havens. Since 2017, tax authorities have recovered over 130 billion euros in unpaid taxes through CRS enforcement. While some dismiss fears of a millionaire exodus as overblown, others warn of serious economic consequences. Millionaires contribute significantly to business creation, employment, and tax revenue, and their departure could strain public finances. The UK is now projected to lose the highest proportion of millionaires globally over the next 4 years. The Adam Smith Institute estimates that the share of UK residents classified as millionaires will decline from 4.5% to 3.62% by 2028. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you later in the week for another episode.